Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Jake Vanderslice. Hi, Jake.
Mike, thrilled to be here. You're a dear friend, a mentor, a partner, investor, and glad to be on today. So thank you.
Thank you for your kind word. Appreciate the opportunity and the pleasure and the privilege to be working with you. It's really been a fun journey. And as we were chatting before this call, kind of investing with you and working with you gives me what I call a tranquility, which is kind of peace of mind, knowing that we're investing with very competent operator, and you are that in self-storage. You know what you're doing, you've done it for years, and you continue to do that. So before that happens, what's the update, Jake and family? Anything new and exciting? What's happening with on a personal level?
Yeah, we got two little boys that are 4 and 3. Our 4-year-old turns 5 tomorrow, so we're gearing up for a weekend of birthday celebrations with the family. A little indoor play place with kids, dinner at my parents'. We've got a Jeep monster truck that I have to assemble tonight. So they're keeping us on our toes. Between that and work, got a lot going on. I know you know how that goes.
Yeah, kids are a blessing. They certainly keep you busy, and that's kind of, you start as they get older and older, you start seeing life through kids more and more. So really happy to hear that you're enjoying your family time and you have a wonderful, blessed family. Now let's jump to self-storage. So what's going on in the world of self-storage? We're recording this in very, very late April, almost May. And just curious, what's happening out there in the world of self-storage?
Well, a lot of what I'm going to say on my market commentary, kind of it transcends asset classes. So a lot of this is not just storage, it's multifamily, industrial, retail. But I guess the theme that we're seeing right now, as we all know, the capital markets environment has changed materially in the last year. I feel like kind of the tipping point when rates started running up, at least in our view, it was kind of September of last year. That's when it really started, like, wow, this is a lot higher than it used to be. So what we're seeing right now in the industry, we are still seeing very high asset valuations. That's a broad comment. Obviously, some deals have come down a little bit, but higher valuations and reduced transaction volume. So there remains a very wide bid-ask spread between buyers and sellers. If you're an operator and you don't have to sell, you're not selling. You're waiting this one out. If you have cash and you have runway on your debt maturity, your cash flows are still good, consumer demand is still good, you're not selling. And the buyers that want to buy are looking at their pricing on their cost of capital. Their interest rate went from mid 3s to 7 or 7.5, depending on the product type, maybe low 6s. And they can't pay the same price that they could pay a year ago. So we're seeing reduced transaction volume, and I think that theme is going to be in place for certainly the rest of this year. Within the storage space, there's a couple different types of deals, some of which are trading still very aggressively and others which are not. So the deals that are not trading like they used to be are deals with a heavier revenue lift. And example of those would be certificate of occupancy purchases, development deals. We see a lot of entitled development sites going to market. The developer couldn't get the equity, couldn't get the debt. Their hard costs are too high, so they're trying to sell the entitled site to a third party. So really the heavier value add component deals are not trading like they were. The deals that are still trading very aggressively are deals that are nearing economic stabilization, but not quite there yet. So a buyer can step in, they can buy that trailing cash flow, and they have a story within maybe 24 months to get to, say, a 6% yield on cost or 6% cap rate from a mid-4 cap rate. So the deals like that are kind of nearing the inflection point of stabilization, but still with some runway and some value to create, those are still trading at cap rates that are well under 5%. And buyers generally on the leverage side we're seeing a lot lower leverage in this environment than we were a year ago. And the reason for that is obvious. They can't make their debt service coverage ratios work, and lenders are advancing lower proceeds. So a down the middle loan to cost a year ago might have been 70%. Today it's more like 50. So reduced proceeds on the acquisition debt front, and reduced transaction volume, I think, for the near term. So we'll see what happens.
Yeah, I appreciate that. Great update. A lot of color. So the bid-ask spreads, that's exactly what we've seen. Transaction volume down. I heard this figure, and it varies. I don't know whether it's applicable to storage, but probably something along these lines. Transaction volume year over year in commercial real estate is down 70%. It's like a big number.
Yeah, I believe it.
Storage may be a little different, but probably somewhere ballpark. And your comments on the debt service coverage ratio are critical. I mean, that's effectively the impact of rising interest rates. You can't take the same leverage. 70% leverage, like you said, when the rates were in the threes, now you have to be at 50% leverage to cover the same debt when the rates are in the sixes, right? So, and if it's above 7, it's even worse. The math, of course, forces lower LTV, lower loan to cost, and but what's really amazing is what you just said. The deals are trading still at lower, high values, lower cap rates. If they are near completion or light value add, let's just call them light incremental value add, where the risks are not as bad as heavy value adds, like a certificate of occupancy or the whole construction ground up, right? So that makes sense. But I'm still amazed that the cap rates haven't really expanded. I guess the first step in the cap rate potential expansion is collapsing the volume, right? Then you got desperate situations, and that's when the transactions will take place. So do you see some distressed sales coming from bridge loan maturity? They didn't finish value add, they got delayed. Is that the time for the fresh dollars to come in and opportunistically start buying when the sellers are distressed and motivated? Not the assets, but the sellers.
Yeah, I'll answer that question, but most of us have seen The Big Short. Remember, they're all sitting there watching their computer screens, wondering why the value of these bonds hasn't dropped yet. Like, all the math says the value should be going down, but they're not going down yet. So it's kind of the same thing to a degree in commercial real estate or storage. If you do the math, right, you can't pay a stabilized 5 cap and finance it a 7, right? That just doesn't work. So I think inevitably there's got to be some asset devaluation. I'm not sure what that's going to look like, and we'll see what the forward curve does. We'll see what the Fed does. But I do think there's going to be some opportunity for distressed acquisitions because of debt maturities, to your point. So in Q3 and Q4 of this year, in the storage industry, there's about $2 billion, which is not a huge number, but about $2 billion in commercial mortgage-backed security debt maturities on floating rate loans. And of those loans that are maturing in Q3 and Q4, as of about a month ago, a quarter of those were on the watch list from declining debt service coverage ratios because they're floating. Now, they're not declining necessarily because they're seeing an NOI reduction. They're seeing an increase in their cost of capital. So what is an operator going to do when that debt matures? They've really got 2 options, depending on what interest rates do. They can either bring equity to the table to refinance, which is no fun, calling capital on a deal that's underperforming. No one wants to do that. Or they have to sell. And they have to sell at probably a valuation that's not attractive to the deal, but they need to get out from underneath their debt. Now, depending on the health of the lender, if you have a good relationship, you could pretend and extend, you could mod the loan. But the lenders we talk to who run their balance sheet product, meaning floating rate loans that are held on the bank's balance sheet, they're having a lot of coverage covenant conversations right now with their borrowers. And they're not working with them as much as I would expect them to work with them. So I think there'll be some opportunity, not just in storage, but multifamily, really all asset classes. When someone was attracted to a 2.5% debt interest rate in 2020 on a floater, stressing their model up to a 4, saying, okay, we're going to refi at a 4 or 4.5. That's nice and conservative. We're going to hit our NOI projections. Well, now they're refining at a 6.5 or a 7 or whatever the rate might be, a lot higher. So we see some opportunity coming up. We're already seeing that happen to a degree. We bought a deal in Fund 3 in February with the same underwriting assumptions that we always make. And that was a 19 IRR and a 3 multiple underwritten. And we learned within a few days of closing that the seller's debt matured the following week. So they gave us a good deal knowing that they didn't have an option to refinance back out of it into term debt. And they kind of ran for the door. So I don't see this happening in a large amount of volume, but we're certainly seeing a little bit more attractive acquisition opportunities compared to what we were seeing a year ago.
Yeah, great commentary as well, and appreciate your wisdom and insight that of this deal example where seller was motivated. Of course, they hit it. They didn't want to make it not something you advertise, but that was a critical pressure point on them. So,
and Mike, it's not just the floating rate debt maturities. It's we're coming out of this era. We're out of this era of irrational exuberance, right? Everything worked so well for so long. And in 2022, for example, we underwrote, we looked at 900 deals. We financially modeled 250 and we closed on 8. And the reason we only closed on 8 is we weren't seeing stuff that we liked with good risk adjusted returns. Now, the interesting thing and kind of scary, but also some opportunity is most of those deals we looked at not only traded, but they traded for substantially higher pricing than we could make work in our model. So you've got this kind of, I don't want to say it's a ticking time bomb, but you might say it's that. You've got this perfect storm, so to speak, another cliche in the same paragraph. You've got this perfect storm of deals that were bought with aggressive and untenable underwriting assumptions on floating rate debt. And I think those two things put together, and this is not just storage. Once again, I think it's all asset classes. I think those two things put together are going to create some exciting opportunities. What level those manifest remains to be seen. I don't think it's going to be a macro, everything's a fire sale at 20% off from what it was before, but we'll certainly see some duress for those reasons.
Yeah, appreciate the wisdom, and I agreed 100%. It's not storage. In fact, the amount of problems in value add multifamily and some other value add deals is higher than storage, because a lot of storage projects were bought a little bit more longer term debt, a little bit lower leverage. At least storage has always been a little bit of more conservative sort of investment class. Although, of course, it's been higher leverage deals. But multifamily value adds, yes, I've seen. And the crazy part is that what do you call it? In multifamily, 95%, if not higher, of value add deals were taken down with the bridge debt. I mean, it made no sense to get Fannie Freddie paper from the start when you can refi a year or two later after the value add execution, or 3 years, and all those assumptions that the rates would be, if they go up, they go up a little bit. Nobody foresaw this whole fiasco, and that's the difficult part is how does the industry survive without really crushing and burning like a cliff? They call it debt maturities cliff later this year into next year, because the current, and people are still talking about Fed raising interest rates another quarter. It doesn't even matter. The damage has been done at this point.
Yeah, the
numbers are so much higher that whether another quarter happens or not, it's irrelevant. It's just how long the rate's going to stay here. And my theory is they're going to try to keep the rates at the elevated level or restricted level for at least 6 months. But the big problem is if stuff starts breaking, they might have to move earlier. But that aside, storage industry at least feels a little bit more conservative. So as an owner of properties, as long as you have good debt and you're holding it, you can just cash flow and not sweat it. And if you can bring a product to the market later, let's just say in a year and a half, 2 years, you're probably better off than bringing it to the market in 6 months. But I'm just curious, even in this environment, are there buyers willing to pay premium prices for aggregated product? In other words, sort of buying pieces and then selling as a whole as a bigger package. Do you see sort of REITs coming in or bigger players and still paying premium prices for an aggregated product while they've lost all their appetites and they're sitting on sidelines and looking for phenomenal deals? What are you seeing?
Yeah, well, one good example of kind of the industry consolidation, which you might have heard about, is the merger between Life Storage and Extra Space. They are going to leapfrog Public Storage, which was far and away the number one biggest storage owner operator in the world. So that's a big one. As far as portfolio sales go, yeah, we're still seeing lots of data points that support the theory that in scale and on a portfolio basis, the whole is greater than the sum of the parts. So, for example, let's say we have a deal in Pensacola, Florida. A regional operator in Pensacola might pay us a 6 cap for that asset, right? They've got a few facilities in the area. They might pay us a 6 cap. If that deal is bundled up with a portfolio of other deals, it's maybe $250 or $500 million. You're going to attract generally a larger private equity or institutional buyer who is under pressure to deploy lots of capital all at once in a single transaction. And they will generally pay a premium for that scale as opposed to buying these things one off. So that same Pensacola deal might trade at a 4 cap as part of a larger portfolio. So as we explore the appropriate timing to monetize the value creation in some of our portfolio, that could be one of the paths that we take. What we don't intend to do is, especially within our funds, is sell deals off on an individual basis, because you start, even if it's an attractive sale, which we might consider doing if it's an offer we can't refuse, but you start diminishing your scale and diminishing that attractive aggregation and scale component to a potential new buyer. So our general thesis throughout our entire portfolio is accumulating these one-off deals that are owned by relatively unsophisticated operators, buying these over time, and then building an asset base that's large enough that we could eventually monetize and get some of those value creation tailwinds with that scale. So we'll see how that all unfolds.
Yeah, that makes sense. It's like you said, you have two large public companies merging to create even a bigger one. There's economy of scale there, and then even on a smaller scale, it's a big dollar deployment problem for those large operators, and they're willing to pay premium prices, lower cap rates for consuming a lot of product. So it makes a lot of sense. But how does it work in a much high interest rate environment? What bothers me most is a negative spread. So you have a negative spread. Well, the spread was positive when the rates were very low, and then the rates risen so fast that the spread between the cap rate and the interest rate has gotten negative and substantially negative. You're buying at a cap rate of 5 and you're paying 7. That's negative 200 basis points, negative 2% spread. It's a crazy spread. So only way you can meet the SCR with very low leverage, and it's obviously very speculative, dependent on two things. One, raising rents, right? So you can tolerate the negative spread for so long as rents are inflating, right? That's one. And two, you expect the rates to cycle back down, right? If the rates cycle back down, yeah, you can refi and then you can tolerate this negative spread. So what are your thoughts?
Yeah, on these negative spreads, you're exactly right. Buyers are buying on speculation, and the speculation is driven around their pro forma ability to increase net operating income and increase revenue. And really, when you're talking about a going in cap rate, you've got to put some context around the deal type. So if we buy a C of O acquisition, certificate of occupancy acquisition, where we're buying a new facility, but we're buying it empty, our going in cap rate on trailing revenue is negative, right? We're buying a deal with no revenue, lots of expenses, and the metric of a going in yield on cost is kind of not applicable there. So you're right, people are buying these with negative spreads, but what they're modeling out is a trailing yield on cost, say, of a 4. They're financing it a 7, but they're believing in two things. Number one, their ability to grow NOI over time, to get to at least a point where they're covering their debt service. And then secondly, they're believing in a moderation of the interest rate environment, right? They're believing that things are going to peak fairly soon, and then maybe this year, maybe next year, start to kind of come back down to earth. But yeah, because values are still high, your only option for coverage is lower leverage, right? And buyers are just betting on that ability to grow NOI. How that turns out in the coming quarters and years remains to be seen.
Yeah, I appreciate that clarification and affirmation that it's really speculation that the interest rates will cycle down, which is possible, in some degree is probable. I certainly believe that with the amount of debt the U.S. has got used to following reserve policy, zero interest rate environment, the country is addicted to low interest rates as cocaine, and we're dealing with withdrawal, massive withdrawal right now. And it's such a fast and furious, we're in a very destabilized environment. So whoever is going to hold off longest can survive, but a lot of people will not be able to hold off. So that's kind of the thesis. And you're right, if the interest rates cycle back down, and I believe they will, they have to. It's almost like this, we don't have a choice. There's so many problems with these high interest rate environment. Yeah, it's fighting inflation, but it's causing large problems everywhere else that the Fed just didn't foresee. And even if they foresaw it, they still had to fight inflation. So it's almost like you're stuck between a rock and a hard place. But on the rent increase side, I mean, that's kind of interesting. I mean, it's inflation, rent inflation. And do you see storage rent inflation being continuously, what level? What do you think on a forward basis? And I know it varies market by market. What do you generally project? What kind of rent inflation in the upcoming years you're seeing to take place?
Yeah, and of course, as you said, it varies market to market, deal to deal. But I'll give you kind of a few examples of how we underwrite rent growth in a given acquisition. So if we're buying a kind of a down the middle deal, would be a property that's maybe mid 90s physically occupied, but economic occupancy is maybe 70%. And that means that the in-place revenue is 70% of where it should be based on market rates. So on a deal like that, we have a heavier NOI growth lift in the first couple of years of operations as we begin bringing below market customers up to market rates. And then one other deal example, then I'll kind of tie the two together. Let's say we buy a C of O deal, or we build a new construction deal in a single asset syndication. So in those first couple of years of operations, you're mainly focused on physical occupancy growth more so than economic. So you're filling up units at below market rents just to get revenue in. And then once you reach physical stabilization, you start to play with the revenue management by increasing rates on higher demand unit types over time. So after we're nearing stabilization, we generally model 3 to 4% rent growth for the remainder of the hold period, just kind of depending on the market. But we're simply just identifying properties that have below market income streams, below market rents, and then slowly raising customers up to those market rates. And that's really the value creation. And everything I just said, I think that transcends into multifamily as well. Like value add multifamily, you put 10K per unit in capital improvements, and you raise rents over time as tenants turn by 10 or 15%, and suddenly you've created a lot of NOI growth and a lot of value. So yeah, after stabilization or nearing stabilization, it's a heavier lift in NOI growth the first couple of years, depending on the deal, and then kind of 3 to 5% steady eddy from there.
Yeah, I appreciate that. So that's what I was looking for. It's kind of, I guess, stabilized asset inflation, 3 to 4%, which is nothing to sneeze at, but it's not 10% inflation during kind of, post-COVID rapid. But the other key comment is value add, and the value add is you're buying it right, and then you're just pushing the rents up to the market, which is it's a value add in essence. And at least in storage, the value add, you don't have to heavily renovate these units. In multifamily, typically you're dealing with classic look and older units. Now, I will love both asset classes. So, but a multifamily requires more work versus, I guess, storage, where you just took over those units. They're trading less than the market. Maybe you need to do a little fresh paint, but that's about it, right? There's nothing to renovate in the storage box.
Yeah, and to expand for a moment on the phrase value add, one of the reasons that I'm sure you and of course we like commercial real estate investing, and I'm kind of putting multifamily in that bucket. We did a lot of single family homes over the years, well over 1,000. And generally in single family, if you're accumulating a rental portfolio, your returns are mainly going to be from potential appreciation, right? A little bit from cash flow, but mainly from the value of the asset going up on a sales comparison approach, right? You buy a deal for 100 grand, similar brick ranches in the neighborhood, 5 years later are trading for 200. You've created a lot of value. Well, you didn't actually create that value. The market did for you. And one of the cool things about commercial real estate investing is we're forcing that appreciation. We're making that appreciation happen. We're not buying a deal for $10 million and just kind of hoping that in 10 years it's going to be worth 15 or 20 just because the market's going to go up. We're making it increase that value by growing rents, controlling operating expenses, and growing NOI.
That's right. So yeah, that's the difference between value-added investing and kind of investing at the core investing or at the essentially stabilized product. And yeah, in just to be fair for the comparison to the single family portfolios, normally if you buy them right at a steep discount and do the value add work, you still buy at a discount. The concept is the same. You can do value add in residential, you can do value add multifamily, you can do value add in storage. But I did want to add this comment. My observation with the residential, in today's environment, if you go into these, it's gotten so much harder to find these deals to renovate and then to, let's just say, refinance and to sell. It's almost, to borderline impossible, very, very difficult to do it in volume and scale. Well, in the commercial, you can do it. So on a one-off property, of course, but if you're running a profitable operation in the commercial buy, fix, sell, turnkey space, it's got a whole lot harder than doing this in storage or multifamily because you have no economy of scale. I mean, you can buy 300, 400 doors or units in storage, even more, 500, 1,000 on a big project, and the same multifamily, and you have great economy of scale versus single family is just the management issue is bajillion times harder. So from that perspective, I think commercial, that's the reason we moved to commercial real estate. We still do some work in the residential space, but in general, the economy of scale exists in the commercial. Okay, any other thoughts on storage? So on a forward investment opportunity, you have a fund three. Talk a little bit about this. Let's just give your fund three a little overview. And so what does your fund do? Fund three is doing right now. It's raising capital for what projects? And if they're interested, how do they get a hold of you?
Yeah, Fund 3 is, we launched Fund 3 in April of 22. And since then, through the end of February, we've closed on 8 acquisitions totaling about 56 million in gross capitalization. They're deals that are a combination of kind of heavier value add, but also some deals that create current cash flow, just based on the deal type. We're only buying existing storage facilities, and we add value to these first with capital improvements, nothing major, as we pointed out earlier, sometimes major, but generally we're swapping out doors, seal coating the asphalt, new gate systems, camera systems, renovating the leasing office, and just making it basically a rebrand. But most of our value creation strategy is driven by our ability to effectively grow NOI and bring those below market revenue streams up to market rates. So we've got a few acquisitions in the pipeline that are in various stages of either LOI or contract negotiations. We're seeing deal flow pick up a little bit, but it's still a challenging deal flow environment with that wide bid-ask spread, which we touched on a few minutes ago. So yeah, Fund 3 is buying existing storage facilities and just adding value with more effective management.
Yeah, that's great to hear. Now, how would folks get a hold of you? What's the?
We always love to talk shop about real estate. Folks can email me, jacob@vanwestpartners.com. Go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Yeah, I appreciate that. And as you said, as you grow your Fund 3 and you have Fund 2 and Fund 1, the bigger the pie, maybe you could sell the whole thing at a better price one of these days. So from that perspective, there's always kind of economy of scale exercise. but in general, has it gotten harder? Well, I guess the answer to the question is almost obvious. The properties you bought a few years ago in your fund 1 and 2, they're probably cash flowing way better than the fresh acquisitions because of the high interest rates. So you're forced to pay much higher rates and have lower leverage. They assume you still have some cash flow, but it's a lot lower than what it was a few years back.
Absolutely, I think that's a big shift in expectations that investors need to have in this environment. That if you're deploying equity into a private real estate syndication or fund, or really any real estate for that matter, your expectations for current cash flow need to be materially lower than they were a year or two ago. And that's really for 2 reasons that are kind of obvious. One is interest rates have more than doubled. And secondly, asset valuations have not really moderated in general, but back down to where maybe they should be with that increased cost of capital. But we can't predict interest rates. We can't predict cap rates. But we can, to a reasonable degree, control net operating income. There's, of course, outside market forces. So we are singularly laser focused on growing net operating income and in turn growing cash flow. And hopefully the capital markets moderate. We often say you marry the deal, but you date the debt. If it's a good deal with good fundamentals and the story makes sense, and the pricing is attractive and it's downside protected, you shouldn't not buy that deal just because interest rates are now at a 7 versus a 3.5.
That's an interesting way to put it. Marry the deal, date the debt. So
that's right.
If the debt gets less expensive, you find a cheaper date.
That's right. Yeah, you find a cheaper date, and that's making a big assumption that debt's going to get less expensive. But the fundamentals of the underlying asset are what matters most. Obviously, you're going to get in trouble if you lever it up at 80% and your interest rate's high. But asset fundamentals are what we're laser focused on. The debt matters. And of course, that debt is creating a diminished distributable cash flow situation. But the cost per pound on our asset base, we're very excited about. The performance we're excited about. And if rates moderate down, maybe we can increase cash flow and ship out some proceeds on a refi. We'll see what the next couple of quarters hold.
Jake, I appreciate your wisdom. I'm going to walk away from this conversation thinking about, marry the deal, date the debt. And it's such a brilliant way to put it.
That's right. If I can only give one nugget out today, I guess that'll be the nugget. Yeah.
That's a great nugget. Thank you, Jake. Always a pleasure and a privilege, folks. Reach out to Jake. A little bit early in the podcast, he gave you the contact information. Talk to him about storage, his Fund 3, and just, any other questions about what's going on. He's a sharp cat, as you can hear in this podcast. So thank you, Jake. I'm grateful.
Thanks, Mike. Good to see you, buddy. Thanks for having us on.
Likewise. Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.